Good afternoon, and welcome to ProVice's latest webinar. Today, I will be talking about retirement and taxes, strategies to keep more of your money. My name is Shane O'Hara, and I'm a Principal and Executive Vice President with ProVise Management Group. I've been here for the last 10 years and work with clients and have a couple of other responsibilities with the firm. And just so everyone is aware, in case you're not familiar with ProVise, ProVise is a registered investment advisory firm that was founded in 1986. We've got about 30 employees, 12 advisors, all of which are CFPs or certified financial planner professionals. And we manage about $1.8 billion on behalf of about 1,100 clients throughout the country. ProVise is a little different than other advisory firms in that we emphasize the importance of financial planning and go through, other things other than just account statements and things like that when we start to work with clients to make sure that we're looking at all aspects of their finances versus just investments. Before I get into today's agenda, I'd like to share a brief message that our attorneys have provided for us. The information provided in this webinar is for educational and informational purposes only and should not be construed as personalized financial advice. The content reflects current planning strategies and market conditions as of today and is subject to change without notice. Examples and strategies discussed may not be appropriate for every individual and should not be interpreted as a recommendation. All financial decisions involve risk and individual circumstances vary. Please consult with a certified financial planner professional or your own advisor before making any financial decisions based on this information. So without further ado, let's get started. Today, I will be talking about a very interesting topic that we find a lot of individuals that become new clients of ProVise need help with. And that's shifting from I'm saving money to my accounts and investing it for the rest of my life to I'm getting ready to retire and I have more complicated questions and more accounts than I know what to do with, and which accounts do I take things from, and what are these RMDs called? And it just presents a lot of complications that we like to help these clients with. And today will be an overview of some of the common questions and concerns that we find that these individuals new to ProVice's client family typically have. And today I will be breaking the webinar into 4 different sections. The first section is on tax-efficient withdrawals and the impact of longevity, the impact that longevity has on which accounts to pull money from, required minimum distributions, changing of tax laws or potential changing of tax laws, Roth conversions, and when they make sense and when they don't. And then I will be leaving time at the end of the presentation to answer any questions that anyone has. So tax-efficient withdrawals. So just as a brief overview, I want to talk about 3 different types of accounts that we see people often having when they get to retirement age. The first is probably the most common. It's called a pre-tax account. And these are IRAs, 401ks, other work retirement plans where people put money into them. They don't pay taxes on the money that they put in, or they get some sort of deduction or something. And then the money grows in those plans throughout their working careers, and you don't have to pay taxes on any of the growth or anything that happens, between when money was put in and now when you're getting ready to take money out. The flip side of that is that when you take money out of those accounts, they're fully taxable to you. The second type of account is called a taxable or non-qualified account. These are, such as individual accounts, revocable trusts, joint trusts. It's money that is put into on a after-tax basis, and you pay taxes on these accounts as gains are realized, dividends or interest are paid to the account. You can use losses to offset other gains and a portion of ordinary income. So there's a lot of flexibility with these types of accounts, and there's no restrictions on how much you can save to them on an annual basis, like the pre-tax or retirement accounts I talked about a brief moment ago. And the third type of account is a Roth account. Now, these come in different shapes and sizes. The 2 most common is the Roth IRA or Roth individual retirement account, similar to the pre-tax IRA. individual retirement account, and then the Roth 401k. And the difference between Roth and pre-tax is that after-tax money is contributed to the Roth IRA or 401k. You don't get that deduction, and you'd already paid income tax on that, which is different than the pre-tax I mentioned before. And the benefit is these accounts also grow tax deferred so that there's no tax paid on anything as money is growing in the accounts. But then when you take withdrawals from them, it all comes out tax-free to you as well, after you meet certain criteria similar to the pre-tax, like being over age 59 and a half and things that we won't get into in this webinar, but it's definitely something to make sure that you're aware of as you're navigating this as well. Now, one of the reasons why it's important to look at the different accounts that you have and come up with a plan for making tax efficient withdrawals is because ultimately the types of accounts you have and the amount of withdrawals you take is going to impact how long your retirement savings lasts. RMDs, or required minimum distributions, can push you into a higher tax bracket if you don't prepare for them and have to start taking them in the future. Changing tax laws can also make planning essential. We know what tax law is today, but we don't know tax law is later on this year even, or next year, or the year after that, or if a change in administration happens, or political parties, those types of things. So it's important to always keep your eye on any potential changes that may be coming up. And then Roth conversions, when done strategically, can be a major help to the longevity of your retirement assets as well. And I'll get into more specifics on that here soon. And typically, what we see people do with the 3 different accounts there is they will withdraw from taxable accounts first. So if they need a new roof or AC unit or a car or any of those types of things, withdrawing from a taxable account doesn't necessarily mean taxes are going to have to be paid, because if you have cash in a taxable account, you can take cash out with any tax implications at all. And then we see people use the tax deferred accounts to pay, normally for things like, a set amount on a monthly basis, things of that nature. But it's really important to pay attention to what tax bracket, what Medicare bracket you may be in, because the money you take out of those IRAs and pre-tax accounts can impact that. And then what we see people is leverage Roth IRAs for tax-free growth and withdrawals in the future. And one of the best analogies I've seen out there on how to think about these different accounts is the analogy of a well-planned garden. And the way that I've described this is Roth IRAs are kind of like a fruit tree. It takes time to grow, but you eventually produce fruit. And once they're mature, you can pick that fruit whenever you want and not have to worry about it. Traditional IRAs and 401ks are kind of like the vegetables. They're the things that you have to pay attention to, which is not necessarily true in real life. How much you're taking. I guess you don't want too many vegetables, maybe, even though I've never heard of that. But it's kind of like your staple. Those replace your income you were making before. It's taxable just like the income you were making before when you were working. But it's really important to pay attention to make sure you're not taking too much of them and knocking yourself into a higher tax bracket. And then the taxable brokerage accounts are kind of like the herbs, basil, those types of things that you're snipping off here and there, and you're using to make your recipe taste better, which is kind of what we see clients do with their taxable brokerage account. Needing a new car, as I mentioned before, AC unit, repairs on the home, new roof, those types of things, because it doesn't necessarily come with a tax bill that's associated with making a withdrawal. But you may have to sell something for a gain within that account, and so it can impact your taxes a little bit. When you manage these different accounts wisely, it helps prevent unnecessary taxes and surprises. And one of the biggest surprises we often see from people who may be just hiring us, or someone who may not be as a client, is what you withdraw from those taxable accounts or pre-tax accounts, I should say, and gains you take in your taxable accounts can impact Medicare premiums 2 years down the road and can put you in a higher tax bracket. So it's really important to manage those prudently. And it's also one of the reasons why a lot of planning goes into when you're going to have to start taking required minimum distributions or RMDs, which is a nice segue into our next topic, RMDs. And RMDs used to be relatively simple in that you started to take money at 70 and a half. The government forced you to take money by April of the following year, you turned 70 and a half. But in 2017, things changed a little bit. And RMDs got pushed back into age, I believe it was 72 to start. And now it's 73 for folks who are born between 1951 and 1959. For folks that are born 1960 and later, RMDs don't turn until you're 75, which would be in 2033. Now, as I said before, you can delay your first RMD until April 1st of the year following you turning 73 or 75, depending on when you turn those ages. The issue with delaying it for that, half a year or however long it is that then in that next year, you're going to have to take 2 distributions out, which could, again, push you in a further tax bracket and increase your income and taxes that you would have to pay in a year. So typically what we advise clients to do is the year you turn 73 or 75, when you have to start taking RMDs out, take it that year. And that way you can limit 1 RMD every year instead of having 2 RMDs in that initial year. Now, what happens if you don't take RMDs? Missing an RMD is something that's penalized pretty severely. 25% of what you should have been taking out as an RMD is the penalty, and 10% if you correct it within 2 years. In reality, we have seen someone miss an RMD from time to time. I have a new client I started working with, last year, and she had a former advisor and, unfortunately missed that RMD the year before. But all that we did is work with her CPA, fill out a form 5329, send it to the IRS, and generally they waive the penalties on those. So although it's really important and severely penalized, if it is penalized, it is something that if you're proactive and you fill out the proper form and work with your CFP professional, it can be corrected, and they could waive the penalty for you. The issue again is that client I talked about earlier had to take 2 RMDs in that year. So it doesn't come penalty free in that higher taxes were paid as a result of having to take 2 in 1 year, but is much better than having to pay 25% or 10% or whatever that penalty was. So what are some of the ways that you can reduce your RMD's impact? One of the major ways that I'll be getting a lot more deeper into later in the presentation are Roth conversions. And there's a couple of different time periods that make sense to do Roth conversions. And basically what a Roth conversion is it's taking money out of pre-tax accounts and converting it over into a Roth IRA. You have to pay tax on the year that you do that, but there may be years after you retire where you're in a lower tax bracket, and it could be advantageous to do that sooner rather than waiting for RMDs to kick in when you're 73 or 75 down the road. Another way that a lot of our clients reduce their RMDs is called a qualified charitable distribution, or a QCD. And that allows you to donate a portion or all of your RMD potentially to charity. There's a couple of things that you want to make sure that you do with it. Have the check go directly to charity, have it be made payable directly to them. Don't take it and cash it and then write a check to charity. You can do $108,000 as a maximum per year, and that's inflation adjusted, so it could change next year. And one of the other things that's kind of interesting about this, and I said it earlier, was RMDs used to happen when you were 70 and a half. They never went back and changed the QCD limit, and that you can be 70 and a half and not be quite taking RMDs yet, but you can do a QCD once you're 70 and a half versus waiting all the way to 73 or 75. Another thing you could potentially do is take a QCD out of your IRA and fund a charitable gift annuity at like a local charity that you're interested in. You basically are buying an annuity with them, and they pay you some sort of income on an annual basis, typically, or I've seen it monthly or quarterly as well. And that you can do up to $54,000 for the year. And that again is inflation adjusted. So that could change again next year. And then the third thing to reduce your R&D is really to, again, I said it a little bit earlier, be proactively planning for R&Ds to happen and try to spread withdrawals out over more years. And one of the ways you can do that is spending some of that money and using that money earlier in retirement than 73, or maybe it's doing those Roth conversions I mentioned earlier. Now, current tax law has a major impact on ultimately how long your retirement assets will last and the total tax bill that you're going to have throughout your lifetime. And there's a couple of things that are out there right now that I think retirees and soon-to-be retirees should be paying attention to. And the first of which is in 2026, the current tax law is set to expire and go back to what it was pre-2017 during the Tax Cuts and Jobs Act. Now, the current administration and ultimately, both parties in Congress are talking about making some of those changes permanent, but, they're negotiating and still, nothing has passed at this point. So if nothing happens, they are projected to go up and back to what they were prior to that. Again, RMD age right now is 73. It's supposed to go up to 75 in 2033, but that could ultimately change. I mean, there's been rumors that they're going to increase that again, maybe something higher than 75, or maybe put in some higher years between 73 and 75. I mean, ultimately, no one knows, but it's something to definitely pay attention to for folks that are not quite taking RMDs yet. And then the last thing is estate tax considerations. Right now, a person can pass more than $13 million to a loved one when they pass away, federal estate tax free. Again, that was changed in 2017. And at the start of next year, that's supposed to go back down to $6 million per person if nothing happens. Again, I think both parties have talked about doing something and making some changes. That's one of them. So I don't know that that'll end up happening, but definitely something that you want to pay attention to and make sure that you're planning for as well. So what are the things that you can do now to take advantage of future taxes if they go up? Well, I said it a little bit earlier. Tax rates right now, you're aware of what they are. And so you know what the numbers are, what the tax impact is going to be if you make a withdrawal or a Roth conversion or anything like that. Next year, you won't know what that's going to be. Future years, obviously, you won't either. And so a lot of what we talk about to clients is hedging their bets and making sure that they've got their taxes or accounts kind of spread out in that way, regardless of which way taxes go, that they're set up for success. Again, consider Roth conversions and gifting strategies like QCDs. And lastly, stay informed and adapt your financial plan. Although with a lot of clients, we may write a financial plan early on. The financial plan is always evolving and changing, and it's dynamic, and it's important to weigh the changes that are going on in the world and tax law and everything else and see how that impacts your financial plan. And finally, I know I've alluded to it a few times, but let's talk a little bit about Roth conversions and when they make sense and when they may not. So again, just as a reminder, a Roth conversion is taking money in a pre-tax account, withdrawing it into a Roth IRA, and you pay taxes on the year that you do that. But the benefit is then it's in a Roth IRA and grows tax-free forever and ever and ever, and there are no R&Ds on Roth IRAs. So let's give just a brief example of how this would work. Say I had a IRA with $1 million in it, and say that I had $100,000 between here and the next Medicare and tax bracket. I could take $100,000 out of that pre-tax IRA, leaving me with $900,000 in the pre-tax IRA, and convert that $100,000 to a Roth and have $100,000 then in a Roth IRA. Now, let's say I'm in the 20% tax bracket or something. I would pay the tax, the $20,000 in that instance, on what the $100,000 I put in the Roth, but then I have $100,000 in the Roth that's growing tax-free forever. So you can see that, I may have been working in the 37% bracket. And so it made sense to put money in a pre-tax because I'm saving 37 cents of every dollar that goes into the IRA. But when I retired and I'm no longer earning that earned income, I'm in a lower tax bracket. And so, 37% or 20%, I'll take the 20% trade off every day and pay taxes at that rate and reduce my RMDs in the future. And, there's a whole bunch of estate planning advantages that come with it as well after some of the changes that they've made for people who inherit IRAs. Now people that inherit an IRA or a Roth IRA have to take that out over 10 years, or a lot of people do, I should say, because there's some caveats there. So there's a lot of benefits from doing these Roth conversions. And some of the times they make the most sense to do is oftentimes if someone retires at, say, 65 and they don't start Social Security until 67, so you have like a 2-year window of much lower taxes during that period of time when Roth conversions can make sense. Say someone's going to wait until 70 to collect Social Security. Then all of a sudden you have from 65 to 70, so 5 years to do Roth conversions and capitalize on the lower income bracket that you'll be in during that period of time. And the other window too is, maybe you start taking Social Security as soon as you retire, but RMDs don't start until you're 73. And so there's a big window there between when the government forces you to take RMDs out and when you retire where Roth conversions can make sense. Again, you're locking in today's lower interest or lower tax rates. You know what the rates are today. You may not know what they are tomorrow. And you also reduce your heirs tax burden as well, because if I'm withdrawing money in over 10 years from a Roth account, I'm not paying tax on that if I'm the person inheriting this account, versus if I'm inheriting a pre-tax account, I have to pay tax at my own individual rate if, my parents or someone that I inherited a pre-tax account from. So when do Roth conversions not make sense? So oftentimes if the current conversion that you do pushes you into a higher tax bracket, it may not make sense to do a Roth conversion. If it pushes you into a higher Medicare bracket, there could be a reason to not do a Roth conversion right now. So it really is a case-by-case basis in working with your advisor to make sure that it's appropriate for you, and making sure that you're looking at all the different things that go into realizing higher income in a particular year, because that's really what you're doing when you're doing a Roth conversion. If you need money extremely soon, then I wouldn't be looking to do a Roth conversion right away. You've got to wait 5 years after when you do the conversion to take money out penalty free. So it definitely makes sense for some people who don't need that money at all and to do it in more of an estate planning tactic as well. And then the other thing too is, if I'm in a high tax bracket and my beneficiaries who will be inheriting the pre-tax money are in a lower tax bracket and plan to be that way, then it may not make sense to take money out at my higher tax bracket of 20%, say, to have it be in a Roth for my beneficiaries to inherit if they're going to be in a 10 or 15% bracket for the rest of their lives. So I know that, it may not be something that that folks are aware of like, okay, well, I can't really worry too much about beneficiaries, but something that, if you're starting the conversation with children or whoever's going to inherit these accounts, that you can, certainly broach that subject as well. So just kind of summarizing what we've gone through today, a smart withdrawal strategy really helps your savings last longer and can keep your total tax bill throughout your retirement as low as you can get it. RMD planning is extremely important. It prevents a lot of unnecessary surprises and also puts you in control of where your money is. And tax law changes can change things a lot. And so it's really, really important to stay abreast of what's going on in Washington, stay abreast of what's happening in your, individual state, if your state taxes income or retirement savings, that type of thing. And lastly, Roth conversions can be a wonderful tool, but timing is really, really important, and everything really is on a case-by-case basis. And so you really need to, look at it yourself and analyze it yourself, or if you're, working with an advisor, work with them to see if it makes sense for you. So in terms of next steps, one of the things we work a lot with clients on is kind of looking at year by year what their tax bill may be at the end of the year. It's also making sure that we're doing proactive Roth conversions, taking money from pre-tax account, those types of things to lower the overall tax bill for someone's retirement. Make sure that you're planning to take R&Ds early or plan for R&Ds early in your retirement so that it doesn't surprise you when you get to that certain age. And then lastly, again, see if Roth conversions make sense for your financial goals. So with that, I'd love to open it up for any questions that anyone has in the audience. Feel free to use and I probably should have reminded everyone at the beginning of the presentation, but there is a Q&A button at the very bottom of the window where you can type your questions directly in there. And lastly, here are disclosures for while everyone's submitting their questions. We did have a few clients who emailed questions previously, so I can go through a couple of those right now. The first question is, if I do a Roth conversion, how much will I pay in taxes? And the answer to that question is a little bit complicated because it all depends on your tax bracket. So if you are in the same example I gave during the presentation, if you're in the 20% bracket and you've got, more than you're wanting to convert to the next bracket, and then you're probably going to pay taxes at that same 20% rate. Having said that, and the same thing with the presentation, it really is important to make sure that you are paying attention to those brackets, making sure that you are paying attention to the Medicare brackets more importantly, because, if you're doing a Roth conversion, you happen to go over the tax bracket, it's only those next dollars that are taxed at that higher rate. If you go over the Medicare bracket, it's your entire premium 2 years from now is going to be higher by whatever that amount is. So, really important, the Medicare bracket, even though it's not in dollar terms, a trivial amount, for a lot of people that are converting big dollars, it still is, a little frustrating to 2 years from now get a letter from the Social Security saying, hey, your Social Security benefit's going to be a little bit smaller this year because of that thing you did 2 years ago. But overall, wonderful question. And then one other one came in here, and it looks like it's a double question. For purposes of quarterly estimated tax payments, does it matter when during the year you take your RMD? And then should I wait until the end of the year to take my RMD? So to answer the first question, does it matter when during the year to take your RMD for quarterly estimated payments? And again, like a lot of the answers that we give, it depends. So the IRS wants you to pay taxes as you go throughout the year. So if you realize a bunch of income in the first quarter or second quarter, they want to see you pay taxes in that same quarter. So one of the ways that we make sure that happens is we withhold federal or state income tax, or both of those, from RMDs that we're sending out to clients. So in that way, you make sure that you're matching up, hey, here's when the taxes are paid in the first quarter, the same quarter that I'm getting my RMD or amount that I'm taking from the pre-tax account. And then the second question, should I wait until the end of the year to take my RMD? Again, it depends. If you're retired and you're relying on the money from your pre-tax account to pay all the bills and do all the things that you want to do, there's nothing wrong with taking it at the beginning of the year. There's nothing wrong with taking the equal amount out over the entire year if you wanted to do it monthly or quarterly. For clients who don't need their RMDs and they've got money outside of the retirement plans, a lot of times we have them take it in October or November of the year. And that's strictly just because, historically, 3 out of 4 years in the stock market are positive years. And I know I'm talking about this during a little bit of a downturn that we've had over the last week and a half or so. But 3 out of 4 years historically have been positive years. And so you're hedging your bets and putting probability on your side if you wait towards the end of the year when hopefully that account is a little bit bigger than it was at the beginning of the year. All right, next question. Do beneficiaries have to pay taxes on Roth earnings that occur after date of death if they don't get the money out of the account right away? So the way this normally works is if someone has a Roth IRA, they have beneficiaries on the account. Could be a spouse, could be children, grandchildren, nephew, friend, whomever. And once that person who owns the Roth IRA passes away, the beneficiaries get notified and then they open up inherited Roth IRAs. And then whatever percentage of the account, say it was 50-50, 50% would go to the beneficiary inherited Roth IRA for the first beneficiary. 50% would go to the next inherited Roth IRA for the other beneficiary. And then they would basically, most of the time, if we're talking about children, have 10 years to take money out of that account. And the way that the law is currently written, for Roth IRAs, there's no required minimum distribution, so you don't have to worry about distributing anything on a year-by-year basis. And, I would use the historical markets and how they function throughout history as my guide, and I would be taking most of that money at the end of that 10-year run rate that you have to take money out of that account. Having said that, if, obviously if there's a need for some of the money, if they're buying a house or, purchasing a business or whatever they're doing, every beneficiary has their own financial circumstances and what they ultimately would like to accomplish. So it's a case by case basis, but there's no taxes to pay on any earnings or anything like that when it's left to someone in a Roth IRA. Another question, is this something we would work with our ProVise advisor to determine the case-by-case situation? Absolutely. I kind of just gave a very brief and high level overview of some of the strategies that we work with clients to do. But something I said in the presentation could not, be applied to your specific situation. So it's really important to have these conversations with your own advisor and make sure that something that I talked today is appropriate for you. Because I can think of the clients that I work with, and a lot of these things make sense for some of those people, but a lot of them don't, in their particular situation. So everything really is a case by case basis, and always great to, reach out to your ProVise advisor if you have one. If you don't have a ProVise advisor, you can go online and fill out the contact me form, or, feel free to, email me either way, and we can get you in touch with someone. Someone's asking here, what's the RMD calculation? How is the dollar amount calculated? Thank you. So RMDs are recalculated every year, and there's two functions that go into the calculation. The first is going to be the year-end value of the previous year. So if I were talking about 2025 and my RMD, I would look at the value of all of my IRAs on 12/31/2024. And then the IRS has a divisor that you use, that you divide that amount by to get your RMD. And so year by year, if your account stayed the exact same from last year to the end of this year, your RMD would grow by a little bit more because you're a year older. But if the account grew in a year, you also got older, from last year to this year. So your account or your RMD could go up by a lot that specific year. Same thing on the flip side is, the account value went down, but you got a year older, your RMD could be a little bit less next year too. So two main things that go into the calculation for RMDs. Is the Roth conversion taxed at income tax rate? So what this attendee is asking is it taxed at ordinary income or at capital gains rate? And it's taxed at ordinary income. So it will be taxed the exact same way that any regular IRA distributions would be taxed. So, and for those of you that are not aware, oftentimes long-term capital gains rates are lower than ordinary income rates. So, in this case, the Roth conversion, IRA distributions, any of those types of things are taxed at that higher ordinary income rate. What are the Medicare brackets and where do I find them? So the IRS every year publishes those rates. It's called the IRMA rates, IRMAA, I believe. And if you just Google Medicare brackets rates, it should pop up for you. And like I said, it uses the previous 2 years ago. So for example, if I'm looking at my Medicare rates that I'm paying for 2025, that's based off of my income in 2023. So anything I do in 2025 will change or could change my premiums that I pay in 2027. So really, really important to pay attention to, especially because, like I said during the the presentation, or I guess earlier in the Q&A part, Medicare brackets, the second you go a dollar over, it's you get a higher premium for that entire year 2 years from now, as opposed to income tax rates. It's just that next dollar if you happen to go over the next bracket. So this is a really complicated question. The question is, I have a real estate asset in a Roth. How does the 10-year liquidation law apply? And so this would be if this attendee, passed away and it was left to any of that person's heirs, then all of a sudden, depending on what kind of beneficiary they were, they may have to deal with taking potentially an RMD each year, but then also making sure all of it is sold and taken out of the IRA within 10 years. I think it probably goes beyond the scope of the webinar. But just as a high level, answer to the question, you're most likely going to have that real estate asset liquidated. That's really the only way that you can get cash out of that IRA if real estate is owned in it. And it's, one of those reasons, because we do have clients from time to time ask about owning real estate in them. And it just makes things a lot more complicated. You have to involve your accountant a lot more than you typically would with an IRA. But you would need to, take RMDs from that account if you're turned 73 or 75, depending on birth date. It just makes it a lot more complicated for you. Okay, here's another question. Does a Roth conversion require a sale of portfolio assets and reinvestment in the new account, or is it just a change of account type designation with the same portfolio? So it's actually taking cash or a specific security out of an IRA and putting it into your Roth IRA. So it's not renaming the account. It's, you taking a distribution basically and just transferring it over to that other account. So again, the example I used during the presentation, if I have $1 million IRA, I can take $100,000 of that, send it directly to a Roth IRA, not withhold anything from that transaction. So now I have $100,000 in the Roth. I just need to make sure that I pay the $20,000 or whatever the tax rate is out of the, my cash that I have, my taxable account, somewhere outside of the IRA that you were transferring the money to the Roth from. What happens to the money in my retirement accounts if I pass away with no beneficiaries? So every state that is in the United States has a will that's written for you if you don't have a will. So the short answer to that question is, if you don't have beneficiaries, it's left to your estate. And so whatever you've put in your will, that's who would get the money in your IRA or retirement account. If you don't have a will, then every state has laws that are in place for people who don't have wills. And the big negative downside to not having beneficiaries on the IRAs, and this is kind of besides the, not having a will part, but no beneficiaries on IRAs or retirement accounts means that it goes to probate, and that costs a lot of money generally. That takes a lot of time generally. It's, again, it's a very slow process. So I would encourage everyone to have beneficiaries on their retirement accounts. So this question is: your recommended course of managing tax brackets in retirement the same if we're not concerned about using all our money? Asked another way, if our primary concern is financial planning for our heirs' benefit rather than us, would we take money out of our accounts in a different order? I would say, this is another case-by-case basis. The answer is yes, it does impact the order that you should take money out of accounts. It probably, assuming you're trying to maximize what's there for heirs, it likely means that you would be a candidate to do Roth conversions. It could come at a cost for you because you would be paying the taxes essentially for your heirs to receive money tax-free when you pass away. So yes, to answer your question, it does impact it. I can't get too specific into the specifics too much just because I'm not aware of everything that's going on. But certainly something to talk to your advisor about. This question's about something outside of some of the material that we talked about today. If my spouse dies and we had a joint investment account, is there a stepped up in basis? So when someone owns something not in a retirement account, so they have a taxable account, if I hold that until the day I pass away and it's just in my account, then I get my heirs, I should say, whoever's inheriting that account, get a full step up in basis. And what that means is if I had stocks that I paid $100,000 for, 10 years ago, and then I pass away today and that account's worth $500,000, the account is revalued. So what I paid for the assets at the level when I passed away. And that way, when someone is inheriting that money and they sell everything, it hypothetically, which probably wouldn't happen the day I pass away, no taxes should be due for those heirs. The $400,000 difference between what I paid and what it's worth today gets erased. And again, this is only in taxable accounts, not in retirement accounts, not in Roth IRAs or anything like that. But this question is specific to having a joint account. And the answer to that is that it gets a half step up in basis. So half of that money gets stepped up. And again, this is state by state. So this is just Florida I'm talking about. Different states could be a little bit different. But, certainly something to talk to your advisor about, talk to your, CPA or accountant about too, because, different states can get a little bit trickier and are probably beyond the scope of today's discussion. Is the RMD lower if I have a spouse more than 10 years younger? If so, is it about 50% less, 75% than if we were closer in age? So it might be beyond what I can talk to because everything's specific to your individual circumstance, but I believe it does impact that RMD. And I believe you're 100% correct that it's only if someone is 10 years younger or more younger than you that it does impact that RMD. That's something that I can I can have your advisor follow up with you if you'd like me to. And I'll write down that now, and that way I can have them reach out. And it looks like that might be the last question. So thank you all very much for attending and for listening, and for your wonderful questions as well. We plan on doing more of these throughout the year in the coming years. So, look for more emails in the future. It looks like there's a couple more that came in. Okay, so they're going to check with their advisor. Perfect. This entire webinar, including the Q&A, was reported today. So if you won't hear this if you're not seeing this, but if you missed it for whatever reason or had to miss part of it or were late to attending, you'll get a copy in the next, I'd say, week or so to be able to watch whenever you'd like. So again, thank you all very much for attending. And if you have any questions, please feel free to reach out to me or to your ProVise advisor or go to our website, and we're more than happy to contact you and help however we can. Thanks so much.